Ladies and gentlemen, good day and welcome to H1 FY26 Results Conference Call of HVAX Technologies Limited. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions and expectations of the company as on date of this call. These statements are not a guarantee of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sakhi Panjiara from Kirin Advisors Private Limited. Thank you, and over to you, ma'am.
Thank you, Dan. Good day, everyone. On behalf of Kirin Advisors, I welcome you all to the conference call of HVAX Technologies Limited. From management team, we have Mr. Nirmay Narayan Singh, Chairman and Whole-Time Director, Mr. Prayag Dutt Mitra, Managing Director, Mr. Siv Mittal, Non-Executive Director, Mr. Siddharth Patel, Chief Financial Officer. Now, I hand over the call to Mr. Nirmay Narayan Singh. Over to you, sir.
Good afternoon, everyone. Thank you for joining us today. On behalf of entire team at HVAX, I would like to welcome you to our H1 earnings call for financial year 26. To begin, H1 has been a period of disciplined execution and a meaningful momentum. Our teams have delivered solid operational performance despite a dynamic environment, and we continue to see healthy traction across both domestic and international markets. The order pipeline in our core vertical remains robust, backed by strong demand for high-efficiency solutions and integrated project capabilities. What stands out this year is the quality of our growth. We are not scaling merely through, but through higher value engagements, project connectivity, and improved margin visibility. This reflects the organization's focus on strengthening systems, building capabilities, and positioning HVAX as a trusted partner in the complex mission-critical environments. A particularly important development this year has been our strategic movement towards the healthcare infrastructure segment. With our proposed acquisition of CREW, we are laying the foundation for a multi-year growth opportunity. This combination aligns perfectly with our long-term vision, integrating project execution strength with a portfolio of specialized hospital and lab equipment to deliver turnkey healthcare solutions. This acquisition is not just about expanding into a new sector. It's about unlocking synergies, strengthening recurring revenue through service and maintenance, enhancing our eligibility for larger domestic and international tenders. We believe this move positions HVAX to participate meaningfully in the rapid modernization of the healthcare infrastructure across India and emerging markets. From a governance standpoint, the board is deeply engaged in ensuring that as we scale, we do so responsibly. We continue to focus on risk management, capital discipline, and long-term value creation. The management team is executing with clarity and confidence, and the organization is building the right leadership depth to support our next phase of growth. Looking ahead to the second half of the year, we remain cautiously optimistic. Our execution pipeline is healthy, our market positioning is strengthening, and we are entering new segments with conviction and capability. At the same time, we will continue to prioritize operational excellence, balance sheet prudence, and disciplined binding. Thus, I want to express our appreciation for your trust and continued support. HVAX is evolving into a more diversified, resilient, and future-ready enterprise. The board and the management are fully aligned on driving sustainable and profitable growth, and we look forward to delivering on the commitments we have made. Thank you so much, and I would like Prayag Mishra, our Managing Director, to elaborate more on CREW Instruments, that is our acquisition here. Prayag, to you, please.
Yeah, thanks, Nirmay. Good afternoon, dear shareholders, and thank you for joining our earnings call today. Myself, Prayag Dutt Mishra, the MD of HVAX Technologies Limited. pleased to report that our company has delivered good financial performance for H1 of FY26, driven by a solid execution across all our key business areas. To highlight, currently our order book stands at 350 crore and the order pipeline of 650 crore. So today, majorly, I would like to draw your attention on the probable acquisition of crew instrument, which Nirvay has briefly mentioned. So this strategic moves will mark HVAC entry into the rapidly growing hospital industry, leveraging crew instruments expertise to expand our offerings and strengthen our market position. The acquisition is expected to drive significant synergies, enabling cross-selling opportunities and enhancing our capabilities to deliver comprehensive solutions to the healthcare clients. Despite crew instrument relatively a smaller size, this acquisition presents substantial benefits poised to create value for our shareholders and contribute to the growth of HVAX Technologies business ecosystem. Thank you.
Now, to elaborate on our earnings, I would like our non-executive director, Mr. Shiv Mittal, to kindly brief on the same, please.
Yeah. Thank you, Nirvay. And good afternoon, everyone, and thank you for joining our earnings call today. Let me share now the financial performance of H1 FY26. Our total income for the first half was 62.79 crore rupees, registering a growth of 35% year-on-year. EBITDA for the period was 8.53 crore rupees compared to 7.15 crore rupees in H1 FY25, a growth of 19%. Net profit for H1 FY26 stood nearly at 4.94 crore rupees, reflecting a year-on-year growth of 29%. While margins were influenced by the stage of project execution, our overall profitability improved in line with the rise in the volumes and efficient operations. These results demonstrate the strength of our business model and the traction we are gaining in both domestic and international markets. Overall, H1 FY26 has been a stable and confidence-building period for HVAC. We are seeing positive momentum across regions and sectors, supported by a healthy order book and a strong. With our expanding presence in global markets, deep technical expertise, and a growing opportunity set across pharmaceuticals, healthcare, and semiconductors, we believe HVAC is well positioned for sustained growth. Our focus remains on delivering precision, compliant, and end-to-end solutions that help our clients operate with reliability and efficiency. Thank you once again for joining us. We look forward to addressing your questions now. Thank you.
Thank you so much, sir. Ladies and gentlemen, we'll begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Our first question comes from the line of Agastya Dave from CAO Capital. Please go ahead, sir.
Good noon. Am I audible?
Yes, sir, you are.
Okay. Thank you very much for the opportunity. Sir, how big is this company? I saw annual turnover of 2.6 crores in the press release. But in terms of balance sheet size, sir, how big is this company and what does it have in terms of is this a manufacturing heavy company or is it more, are you acquiring more customers? How can you throw some light over there?
Hello?
Yeah. Hello.
Yeah. Am I audible?
Yes, sir, you are.
Sid, can you take up the question, please?
Hello.
Sid, are you there?
Yes, yes.
Can you
I
answer
think,
this?
yes, definitely I can answer this question basically. The company which we are acquiring basically, that will help us to unlock a lot of synergies between our businesses. It's not basically manufacturing heavy business. What it will provide synergies primarily is a lot of customers need a lot of bespoke solutions which are very pharma-centric, like, whether they want to manufacture a drug, if they want to come with a particular solution. This company has this technical know-how and knowledge, which today we are actually, getting from somebody else. This will help us to enhance our capabilities at the client side and increase our ability to win more, bigger, larger, turnkey and end-to-end projects. That's how we see this, opportunity to increase our breadth of delivery, basically.
So to add on to
I'm
that,
asking this question.
Yeah.
I'm asking
Yeah,
this question because 2.6 crores is such a small number. I've never seen
Correct.
a pharma plant or a hospital with just 2.6 crores. I mean, that's their annual turnover, so that's why I'm
Yeah.
wondering how
Yeah.
big the company is.
Currently, just to add to that, currently that business is primarily domestic business. Okay. And our 85% of revenue is from exports. How this will help us, this, of course, it's a very forward-looking statement. We believe we can simply make this 15 to 20 times grow with only our existing set of customers. Again, we believe these are synergies which we are trying to explore it, getting them from domestic to global markets.
Sid, can I add to this, please?
Yes, please.
Okay. So to answer very specific, the balance sheet size, as you mentioned, is very small, approximately around 2.25 crores.
Right.
Now, as Sid was trying to explain, this company in itself can grow multifold over a couple of years. Now, what this does is, this gives us a direct entry into the hospital segment. Though the size of the company is small, so basically this company is a split from another company. They split around 3 years back or 4 years back, I guess. And they have only due to, they were not having that financial power. So they were, otherwise you find that this company can by itself grow multifold. And in addition, they'll add a lot of value to us.
Okay. Understood, sir. And sir, my second question and final question for the day. Sir, you mentioned in your opening remarks, and it's visible in the P&L also, that there is some pressure on the margins, but you mentioned that that was because of the timelines and the milestones. Can you elaborate a bit further? What should we expect in terms of margins for the year? And what exactly were the reasons why the margins were slightly lower? I mean, at the gross margin levels, there was a 300 basis point compression, and then the other expenses were up by 200 basis points. So that's a 500 basis point compression at the EBITDA level if you exclude the other income. That's the question on the margins.
Okay. So on the margin, see, what we do is, in the H1, so there were less of, design build projects. That means our consultancy income was comparatively less, if you have to see. So, yes, so that enabled, certain compression on the margins. Going for the year, we believe that we'll be able to attain the margins as we have said previously. So more or less we'll be in line. Talking about the EBITDA level, a compression there. Right. Yeah. So from the EBITDA level, as we are saying, we are diversifying into the different industries. So we are doing a lot, with regards to our sales and marketing. So there's been a lot of investment. We are really going aggressive. So that would be the primary reason that you would find, the compression on the EBITDA side. I hope I was able to answer.
That's understandable also, sir. The additional expenses, upfronting of expenses. So that's great. Sir, any comments on the 650 crores order pipeline? When do we start seeing conversions? When do you expect orders flowing in additionally?
Yeah. So we already converted, by the time when we have sent our last press release, we have already converted an order value of around 35-40 crores. So it is in progress. Yeah. So as the time goes on, this will automatically be getting converted.
Great, sir. Thank you very much for the opportunity, sir. All the best for the coming quarters. Sir, I would once again request if you can consider quarterly earnings releases. That would be very useful for us.
We are exploring usually and badly that, we are able to, give it. As promised earlier, it will take some time, but we are very hopeful, within a couple of quarters, we will be in a position to do that.
Thank you very much, sir. All the best, sir. Thank you.
Thank you.
Thank you so much, sir. Our next question comes from the line of Sunil Katishia from Tanush Investment. Please go ahead.
Hello, sir. Good afternoon. Sir, I'm new to this company. I've got a couple of questions. Help me understand how different this company is from a regular EPC other companies, and whether it is a traditional EPC company or whether it is into PEB kind of a company where you manufacture the product and then deliver it to the company along with designs and everything. Just help me understand this first, please.
Oh, okay. Prayag, can you take up that, please?
Yeah. See, HVAX Technologies is a project contracting company. Sometime we get an opportunity of design build project wherein we conceptualize the project first, we do the feasibility study, and then we do the contracting part, and then we do the validation and handover. So that is one type of project, and the second type of project is we execute the project as a pure contracting company, wherein the consultant is different. Somebody else has designed the project and we become the executor of the company. So it's per se not exactly the EPC company. It's you can say sometimes it's a design build project company, sometimes it's a pure contracting company.
Understood. So, sir, again, related to, because I've gone through the type of the client, you have hospitals and schools and all. So, how different these products are compared to other construction companies? I'm not still getting the actual product delivery. What exactly are you deliver the furniture, or are you deliver the tools, or what? I'm still confused over here. If you can help me understand that.
HVAX Technology is a leading turnkey clean room integrator. It's a specialized environment which is required for the hospital project. Specialized environment which is required for the pharmaceutical and the biosimilars. So we design the project to give them the special environment. And even the special environment, like we are doing projects in renewable energies, also we need a clean room. It's a hygiene environment which we provide. It's not a product which we are supplying. It's it's an integration of multiple products to get you that environment.
Great, sir. And as you mentioned, order book is 350 crore and 650 crore pipeline. What is the run rate, success ratio of pipeline to converted business?
Over a period, we have seen we are able to convert around 20 to 25% of the pipeline. So that is the rough figure which we have evaluated ourselves over a period.
Okay. So as of now, we have got only 350. That means for next 2 years, we have the order in place to execute over a period of time, or just trying to understand.
Approximately, yes, you can say that for the next 2 financial years.
And the margins, as you mentioned, that will be in the range of, first half the margin was not that great, as you mentioned, the reasons and all. But over a period of time, 1 year down the line, you will achieve that similar 14%, or EBITDA margin I'm talking about? Or it will be...
We are well poised to achieve the same numbers, more or less in that range only.
Understood. Okay. Over a period of time, what is the vision of the company for next 5 years? What exactly you guys are planning to achieve?
As we mentioned in our... I think Nirmal will answer this question.
Yeah. So to answer this question, our aspirations are real high. And what we're doing as of is, we are working only for pharmaceutical industry. But if you look at the industries that we can offer our services to, it is huge, right from your hospitals, semiconductors, renewables, batteries, chemicals. So you name it. Our services are required in almost every industry. So to talk about our vision, we are, as pointed out, the endeavor is to grow, but in a sustained manner. So one at a time. So the first is, acquiring this to enter the hospital industry is acquiring clean instruments. Again, we are exploring, in few industries, we are exploring a few companies that could give us a direct entry. So looking ahead, we find that the future is very bright for us. And hello?
Yep.
Am I audible?
Yeah, now. Please go ahead.
Yes. So to answer in line, the future looks really bright. It is how much we can digest. It's only about us because the opportunities are huge, domestically and internationally both.
Okay. And at what percentage CAGR the company can grow over a period of 4 to 5 years, if you can help me understand this, based on your targets and visibility? Yeah.
Yeah. So the visibility that we have given, in our last earnings calls as well, that we look to grow around 35% for next couple of years. And as we diversify into the other industry, as we acquire a few companies into the other industry, this can grow. But as of what we have given is probably we look to grow at around 35% for next couple of years.
And as far as working capital requirement is concerned, future expansion and all, what is the plan to use equity or to create debt more?
So it depends. It depends, see what are the companies that come a long way. For example, as we are acquiring through, we are not looking to, increase any debt or erase any money, from the market, because this should be done. It's a small company. So we are very particular about it as to what we are acquiring and how much we are acquiring. So depending upon the size of the company that we look forward to acquire, it depends, whether we take in a debt or we raise it to the market. So it all depends.
Okay. Great, sir. Thank you so much, and that's all from me.
Thank you
very much.
Thank you. Our next question comes from the line of Prasenjit Paul from 129 Wealth Fund. Please go ahead.
Yeah. Good afternoon, everyone. So my first question is, as we have an order book of 312 crore and recently you mentioned 350 crore. So can you share the execution timeline of the existing order book?
Yeah. So as we said, this 350 crores should be executed maybe in a year or so, or maybe a year or two. So it depends.
Okay. And as we are also entering into solar, maybe semiconductor segment, other than pharma segment. So can you help me to understand, what is the margin profile on those solar semiconductor? Is it higher than the pharma or is it lower than that?
So we are exploring the same, so we are really cautious about, when we are entering these industries, we are really cautious because we really want to be sure about, as to what are the margins. Because since we haven't executed any project for the semiconductors, yes, we have got few inquiries and probably we are bidding for it, but we are not very sure about, as to what would the margins be. But as per our understanding, we find that, it will be more or less as per the margins that we are drawing in today. However, we'll be sure about only after we execute a couple of projects.
Okay. I think you have mentioned that you received one solar order on solar project last September or so. So if you can help me to understand that solar project, is the margin is in line or lower than the current pharma or hospital segment?
So for this solar, actually it was not exactly a solar project, but the company is into solar. It is CG Power. So they are venturing into different things. So again, if you talk about, this project, which was a pilot project for us, just to test it. So we find that the margins are more or less in line, as to what we are doing as of, at least for this project that which is currently in execution.
Okay. So over a period of time, can we expect that the margin to go back to 14%, 15% range, or it will come down from 14% to 13% kind of range? I'm talking about operating profit.
Yeah. It depends. For example, if you are only into the pharma market, if you're doing the revenues as we have, right, only from the pharma market, this gross margins or the EBITDA margins are expected to grow higher. As we diversify into the other industry, we know about hospital industry whereby, the margins are good and probably a little better than pharma. That is a plus point. Talking about the other industries of, say, semiconductors or renewables, we're not very sure about. Unless and until we take a dive into it will be very difficult. So far as we are talking about the pharma and maybe the hospital, we find that the margins would increase.
Okay. Last question, like in the last con call, you have guided around 35 to 40% revenue growth in this financial year. As we are in November, are we on track?
We are very much aligned. Yes. We are very much aligned to achieve the figures, the margin that we have set. We are very much aligned.
Okay, sir. Thanks a lot and wishing you all the very best.
Thank you.
Thank you, sir. Our next question comes from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, I'm audible, sir?
Yes.
Yes, you are.
Oh, okay. Thank you very much, sir, for this opportunity. Just wanted to understand first up a clarification to the last participant you mentioned. What's the outlook that we had given earlier in terms of that you mentioned we are aligned for it?
We're talking about growth of 35% year-on-year for a couple of years.
What about margins?
Margins would be upwards of what we are achieving or what we have achieved even last year. It will be upwards of it, but very difficult to give you an exact number.
Okay, understood. Sure. What's our export mix currently and how should we look at going forward and what's the margin profile in the exports?
Brad, can you take up this?
Yeah. Currently our export orders are like approximately around 70 to 75% of the total order book, and rest everything is the domestic market.
Okay.
Sid, do you want to add on anything?
Yeah. See, as of date, what we speak, 85% of our revenues are from export actually, and 15% from domestic businesses basically. The way we see is, as we go into H2, we'll have this, design building project installation revenues coming in. We have done the supplies in H1, the installation and everything will follow in H2. The way our business is structured is, as we annualize the whole project, we'll see margins not only going back to the previous year, but also expanding as and when we expanding to other geographies, other sort of projects along with the acquisition which we are suggesting. That's how our business structure is.
Understood. Ideally, in second half, your design-led project revenue is generally higher. Is that the right understanding?
See, not directly. If you understand the project cycle, first we design the project, we get the design the entire flow, get it approved from the client. Then we shift the requirements from India to the respective client country. Then it gets installed. Now at times it happens, it can happen in H1, it can happen in H2, it can happen in this is not a quarter, but it can change the quarters as well. For this financial year, what we can say is, H1 was missing those installation or things which we believe, given the shipments have happened in H1, that will follow in H2. That's the project or business cycle, if I'm able to articulate it well.
I got it. Understood. That's very clear. What is our generally the revenue mix in terms of design-led work versus only execution?
That will be what, about 5 to 10%? I don't know the
exactly let me answer this. It all depends on the kind of inquiries we generate. Sometimes it's difficult to tell you the exact ratios on that. Sometimes it's more heavy on the design build, sometimes it is light on the design build. It all depends on the inquiry and the geographical location where we get to bid for the project.
But tentatively, I mean, just wanted to know the range. I mean, is it like maybe 15-20% or 25% would be design-led and remaining would be only execution?
Yeah, you can tentatively you can say that, you know.
Mm-hmm. Okay. Okay. And how is the margin profile different in design-led work versus execution? Only execution work?
In design build project definitely has a better margin as compared to the only contracting project.
Okay.
Because there we have a complete control, complete flexibility of the technology design, doing the value engineering, and generating a better margin on the project.
Understood. And how do we see the mix? I mean, going forward, do we expect this 15-20% ratio to remain as it is, or are we making effort to?
Yeah. I think I can see that visibility is there, like design build project will be there, you know, around 15-20%, we can say that.
No. So I was just trying to understand, are we making effort to kind of increase this share of 15-20% going forward?
Let me ask you, each project is unique. We don't target कि मेरे को 15% करना है, 20% करना है. So our sales or it's client driven, right? Customer driven. So how we see or where the project is?
Sid, let me answer this. Yes, we are establishing our in-house design and consultancy team, you know, so that we increase the design build project more into the export market. Because the domestic market is like heavily dominated by the external consultants. So we see more projects coming as a contracting project only when we talk about domestic market. But yes, export definitely we are increasing our team force, establishing the knowledgeable team for doing the design work, you know. So yes, in going ahead you can see the increase in the number for the design build project.
Understood. Okay. I think that's very helpful, sir. I would like to wish you all the very best. That's it from my side.
Thank you.
Thank you, sir. Our next question comes from the line of Prasenjit Paul from 129 Wealth Fund. Please go ahead.
Thank you, sir, for the repeat opportunity. Sir, my question is, out of this 350 crore of order book, so how much is in pharma and hospital segment and how much is in others?
See, it's mainly all into the pharma. Hospitals, yes, we are exploring, but we haven't concluded any orders in this 350 crore. Yes, before that we executed couple of hospital projects as well in the last financial year.
Okay, so currently majority of them, 90-95% is in pharma.
Yeah, it's in pharma.
Yeah, 99% is pharma, yes.
Okay. And sir, talking about the export order and domestic mix, so do you have better margin in export orders compared to the domestic?
Yes.
Yes, of course.
Okay. So
export orders fetches us better margin as compared to domestic projects.
Okay. So how much, I mean, there's a difference?
It all depends again, like which location we are doing the project. Like when we are getting the project in GCC countries, it has a better margin. And when we are doing the project in the Asia Pacific market, it has a competitive margin. It all depends on the geographical location. But yes, it's better than the domestic projects. That's what I can say.
Okay. And from the present 350 crore order book, how much percentage is in the export orders we have?
I think approximately I mentioned 75 to 80%.
Sorry, 75 to 80?
75 to 80% is an export order out of this order book.
Okay. Thanks a lot, and again wishing you all the very best.
Thank you.
Thank you, sir. Our next question comes from the line of Mahesh Sheth from VY Capital. Please go ahead.
Yeah, hello, good afternoon. Can you hear me?
Yes, sir, we can hear you. Please go ahead.
Yeah, so I just wanted to know that has our execution speed has improved, or is this improving our cash flow?
Can you repeat the question, please? You are too low.
Yeah, so I just wanted to know, has execution speed improved, And is this improving our cash flow?
To answer that, the execution remains the same. The cash flow for the last financial year closing, whereby we have seen that, the debtor days have increased, was immediately because the major billing was done in the month of February and March, which we have already stated that this would ease out, in coming quarters and years, this would ease out, and we'll be able to maintain that. It's got no relevance, that I can say probably our execution has improved and so has the cash flow.
Okay, got it. And are the competitive pressure influencing our pricing in GCC and APAC?
In export market, we don't see any competitive pressure here, whereby, we have to compress your margins. If the pressure or the competition you find is probably there in the domestic market, and that is a very precise reason that we refrain from doing most of the projects here. We have limited ourselves to around 15%-20% executing here in domestic.
Okay, got it. And what capabilities are you targeting through partnerships or acquisition?
Acquisitions will help us, create a lot of synergies, a lot of cross-selling. It gives you a direct entry into the segment that you are targeting. We are very clear about, what is the next domain that we are targeting or the next industry we are targeting. That helps to give you a direct entry.
Okay. Okay, fine. That's it from my side. Thank you for answering.
Thank you.
Thank you. Next question comes from the line of Aditi Roy with Patel Advisors Private Limited. Please go ahead.
Hello, sir. Hello?
Yeah, hi.
Yes.
Sir, what is the capacity utilization in H1 FY26?
Capacity utilization per se regards to?
All our product portfolio.
See, as said, we are service providers, as we say, or as we term HVAX Technologies, it's a leading turnkey clean room integrator. In terms of capacity utilization, it is only our people.
Okay.
We keep developing it. We keep training our people. You can say that, we are utilizing the services of our people to the optimum.
Okay, sir. As I am new to this company, that's why I was asking. Sir, is H2 FY26 expected to be stronger than H1 FY26 given the order book mix?
Yes.
And do you see any... Continue, sir, please.
Sorry, you were asking something?
Yes, sir. Do you see any capacity constraints that could limit growth in H2 FY26?
We don't see because the only challenge that we find in our growth is human resource. That is the only thing that we find, probably could be a hindrance with regards to, our growth. Because if you see the demand for the skilled professionals in the pharmaceutical industry is very high. And we are committed to attracting and retaining the top talent. Now, few initiatives that we have been taking, by having strategic partnerships with the leading education institutions to develop a pipeline of skilled engineers and technicians. We are having comprehensive training programs, to upskill our existing employees. We are also looking at, probably having competitive compensation packages so that, probably we remain an employer of choice. These are a few things, that we are looking towards since we are into the service industry. And as we find probably that the human resource being only a challenge in our growth.
Okay, sir. Thank you. That's it from my side. All the best, sir.
Thank you.
Thank you, sir. Our next question comes from the line of Dhanraj Tolani from Kuber Advisors. Please go ahead. Mr. Dhanraj, you may proceed with the question, please. Mr. Dhanraj, you may proceed with the question, please.
I'm audible?
Yes, you are audible now.
Yeah. Okay.
I just wanted to know on the like margin profile. Currently, if we take the assumption of, let's say, a current book of more than 300 crores, what would be the margin profile?
You are not audible. If you can be a little bit louder.
1 second. Am I audible now? Hello?
Little better. Yeah, can you repeat the question, please?
Okay. I just wanted to know on the margin profile currently, taking under the consideration of current order book. How much of the order, like 680 crore pipeline is realistically convertible into FY26? On the margin part also and on the realization of the revenue also.
Yeah. We find that, the margins would increase. However, on the EBITDA side, as we speak, we are participating in a lot of industry events. We are spending a lot on the sales and the marketing side. Though the margins are there, it depends, as to how much, we are incurring there on that front. But if you talk business operation-wise, yes, we would retain the margins and we'll be doing better.
Okay. I'm just looking at the financials, but EBITDA margin got declined. Like, even if we got the strong revenue growth, but EBITDA margin would decline. I just wanted to know, is this the decline would be sustainable or the current, previous margins would be sustainable margin? Because if we are expecting a better order pipeline.
We're talking about we are talking about the previous margins. Those would be sustainable.
Previous margin. That would be sustainable.
Yes.
Okay. Also considering the order pipeline, what would be the sector mix?
Sorry?
If we take the order pipeline, what would be the sector mix in future?
Sector mix, as we are saying, we are diversifying into the different industry as we speak. Our pharma would, again, for this year at least, will be pharma or maybe, a few additions of hospital projects. Going ahead, it will be very difficult, to specify as to what the percentage would be.
Okay. Okay. Got it. That's all from my side.
Okay. Thank you.
Thank you so much, sir. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone phone. Ladies and gentlemen, as there are no questions from the participants, I would like to hand the conference over to Ms. Sakshi Panjwara for the closing comments. Thank you, and over to you, ma'am.
Thank you everyone for joining the conference call of HVAX Technologies Limited. If you have any queries, you can write to us at resource@careeradvisors.com. Once again, thank you everyone for joining the conference. Have a good day.
Thank you.
Thank you, Sakshi. Ladies and gentlemen, on behalf of Kirin Advisors Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Okay. Thank you. Bye.